Let me tell you something that shocks many analysts. Net profit margin is one of the most overrated KPIs in finance. Yes, everyone uses the net profit margin, but no one can understand how dangerous the net profit margin is. My name is Hisham Mokhimer and I am the founder of The Financier. Over the last 2 decades, I trained thousands of finance professionals on topics such as financial planning analysis, financial modeling, Power BI, IFRS, and financial reporting, and other topics in accounting and finance. And today, I am going to explain one of the most tricky topics when it comes to financial analysis. It is related to the net profit margin and how should we use it. So today, I am going to fix one of the mistakes and the most common mistakes that financial analysts are doing, and usually I see in reports and analysis. When someone tells me that our net profit margin jumped up from 16 to 19%, we are super profitable, I'm going to ask him one question. Was it a business performance or accounting? Because the net profit margin is usually distorted by items such as FX gain or losses, finance cost, and IFRS adjustments, also some changes related to the discontinued operations as well, and even tax planning. Let me give you a real example. A company increased its net profit margin from 10% to 18%. Shareholders are happy, management are celebrating, board of directors are most satisfied, and everyone was excited. But when we dug deeper, we found that the operating margin was almost flat, and FX gain added $5 million, and the discontinued operation boosted the income artificially, and the deferred tax reversal inflated the bottom line. So in fact, the business didn't get stronger. So what real analysts do? They use the following performance triangle. Firstly, they look at the gross profit margin, because the gross profit margin gives you insights regarding the cost control and the pricing power. Secondly, they look at the operations margin, and which is known as EBIT, because this gives you insights regarding the operations efficiency. And finally, don't overlook the cash, because cash conversion measure how your profits turn into cash during the year. And if these three don't move up, so your net profit margin don't tell you the truth. So next time you need to analyze your financial performance, look at your business and how much your business is generating in terms of profit, not accounting wise. So look at the gross profit margin, look at the EBIT, which is the operating profit margin, and also consider the cash conversion efficiency ratios. So the best advice here is to create a dashboard that includes the following. Number one, the operating metrics that are separated from the non-operating metrics. Number two, the recurring items must be highlighted separately from the non-recurring items. So if you have a profit from the discontinued operations, don't include this profit in your net profit margin and say that our net profit margin jumped from 10% to 18%. You have to focus on the continuing operations, because this is what expected to continue every year. And if you have any IFRS remeasurement gain or losses, try to separate it in your dashboard or in your reporting package separately, so management can look on the continuing operations other than the IFRS adjustments. And finally, the FX and the one-time adjustment must be separated and highlighted separately as well. So my advice to you is to prepare your reporting package or dashboard that clearly distinguish and separate between the recurring items and non-recurring items, and operating items and non-operating items. And the FX gain or losses must also be highlighted separately. And if you have IFRS gain or losses as an adjustment, so please separate this clearly from your reporting package, so people and management can assess your financial performance based on the business and how your business is generating profit, not your accounting profit. So next time someone shows you the net profit margin, smile politely and ask him, is it business performance or accounting magic? That's how the real analysts think and how you build trust in your reports. Thank you.